kind of nerve-wracking, but she got to do it. She wants to see her mom.
Hey, Sue.
All right, so I'm going to prepare everything, get this started.
Good. Are you ready, Chris? We're going to go Facebook Live momentarily.
I'm ready.
All right. Who would think that we're this forefront technology people, right, Chris?
Awesome.
We'll have a few other people jumping in shortly on this, as well as going with Facebook Live. All right.
Okay, just give it like 30 seconds.
Okay.
I'm running soon.
Another day, more excitement. All right, we're on live on Facebook right now, everybody. Welcome to the Martin Eiden team's episode 15, right, Jared? Okay, great. Episode 15.
Yep.
Yeah. Episode 15 of Ask the Expert series. And today I'm super, super excited. We have not only an expert, but a good friend, and actually one of my very first clients when I started in real estate 21 years ago. We have Chris McCormick here from New York Life. And Chris is an amazing human being. I consider him a dear friend. And I'm very honored today that he's going to talk a little bit about, retirement. How does that work? Setting stuff aside, a little bit about life insurance. And I coaxed him, and he's super generous to share with us at the end of the show on, how he's, I hope he's not too shy, but he's literally made millions of dollars on real estate. And I'd love to just have him share a little bit about that at the end. So Chris, when we had a little bit of a prep call here, tell me a little bit, what's all this about paying yourself first, and what's that concept, and what does that mean?
Okay, so I want to talk to everybody about long-term financial planning in the gig economy, which is, the gig economy is where you're a contract 1099 worker potentially, or you're working for, short terms and different jobs, but you really have to look after yourself. And one of my golden rules is paying yourself first. And what I mean by that is a cardinal rule in budgeting and saving is to pay yourself first. So once your paycheck hits your account, wisdom has it that you should move some of the savings before you pay the bills, right? So do not save what is left after spending, but spend what is left after saving. That's one of Warren Buffett's great lines.
Can you say that one more time, Chris? Because I think I need to hear that. Say that one line one more time. That's awesome.
Yeah, so do not save what is left after spending, but spend what is left after saving. So if you have an automatic savings account where it's like a retirement account, or you have a mortgage, or you have a savings account where the first thing you do when you get your paycheck is you immediately deduct X amount of dollars and you go to pay into some sort of savings vehicle. And if you can do both a mortgage and a retirement account, you're that much better off. But if you can do one or the other, you got to pick the one that makes the most sense for you. And if you don't have enough money for the down payment for real estate, then you set up a small retirement account. At New York Life, where I work, we offer all those products, and we allow someone to open a retirement account with as little as $500. And then
$500. So it's open to everybody, right? You don't need, I think a lot of, and I know I'm cutting you off here, Chris, but I think a lot of people think I have to have, I need $50,000 before I can start a retirement, or $10,000. And you just said $500 opens the door for you, and you can start something.
$500 and then $50 a month on automatic payroll deduction, a checking account deduction, and then it goes right into the stock market. And the concept is, it's long-term planning. So whether the stock market is up or it's down, every month, we call it dollar cost averaging, and you continue to buy into the stock market. And through your lifetime, that market will, rise and rise and rise, and you will have a large savings account that's accrued and a good return and compounded nicely. So that's sort of the goal. And, so getting back to paying yourself first. So by
Uh-huh.
always paying yourself, sorry, go ahead, Martin.
No, I was just going to say, yeah. So go ahead with pay yourself first. And I think, one of the questions I had before you jumped in on this is, again, similarly, like, I think a lot of people sometimes have the concept of like, well, why bother to save if I can't, unless I'm saving $1,000 a month, like why even bother? And you just mentioned $50 a month, which I think is great. And I think part of the key to this is to start young if you can, all the young listeners out there. And if you're a little bit older than young, whatever that definition is, just get in there and start doing something right away. Is that what you would agree with?
Absolutely. It's a habit forming, right? As you learn how to live within your means and you have a savings plan and you pay yourself first, you'll form good habits and you'll be able to grow your wealth and your financial success. So just to get back to that point, so by always paying yourself first in order to save for a rainy day and then avoiding buying unnecessary things, you'll be able to put yourself in a good position to build a prosperous future. So the final point is to avoid as much debt as possible, right? And we'll get to that in a little while later. So you want to give yourself your benefits, right? So the most important benefits that you can accrue as if you're young is a retirement account, because we just don't know what Social Security is going to yield as we go forward, right? That's a big question mark. And the second thing to consider is life insurance. Now, here's a story on life insurance. If you're single and you're in your mid-20s, you think, why would I need such a thing? Or you're in your early 30s and you're not married yet. So most people can really seriously consider life insurance once they get married and they have kids, right? Because they obviously need to have family protection in case the income earner either loses their job or they die or whatever, right? So but the idea of starting early is that it's another savings vehicle. And there's a couple different types of life insurance, but the true life insurance is called whole life. And it's a savings deal, and you can buy a $50,000 policy and spend $100 a month or $150 a month kind of thing. And what happens is it accrues over time, but your payments remain fixed and low for the next 30 or 40 years. So you're getting in very early with very low payments. And then what happens, let's say you pay off, this thing can become, you're 45 years old, it's paid up. Let's say you took out a $100,000 policy, okay? So you spent maybe $100, $200 a month for this thing over 20 years. Now you're 45 and you've got $100,000 of life insurance value in that policy, but you want more. So then you take that policy and you roll it into $1 million policy, and it doesn't really cost you anything. You take that $100,000 and you front load $1 million policy, and now that policy grows and continues to grow in using stock indexes, which you have available for these policies for the next 30 years. So now you're 75, you got $1 million policy, and it hasn't cost you very much. You funded the thing when you were young for a little bit of money, and now in your late 40s and 50s, your income earning power is much higher, and you've got that much more income that you can spend.
That's great. So just kind of going through that one more time with me. So let's say in my mid-20s, let's say I'm 25, I get, or even 30, right? So it's 20, it's a 20-year maturation with these policies usually, Chris?
Yeah, 20 to 25 years. That's right.
Okay. So let's say, I start at 30 and I want to get a $100,000 policy for 20 years. And it's like, whatever, 50, 75 a month. Then at 50, and trust me, everybody's going to be working here for a long time in this new world. So, or I hope to. I don't believe in retirement. At any rate, so now I'm 50. I have a $100,000 policy. How exactly do you roll that over? Do I take $100,000 cash and put it in the stock market, or do I buy another policy and I have to contribute to that policy, or you mentioned front load? What does that mean?
So there's a tax rule, and you're familiar with this in the real estate market. It's called the 1035 exchange.
Okay.
So you take the original policy and you do what's called a 1035 exchange, and you then sell it. You pay no tax on that policy, and then you take the proceeds and you buy a new policy that is a much larger policy because you're front loading it. So you're depositing the full 100,000 into the new policy and allowing that to grow for the next 30 years or 25 years. And that then
Wow.
continues to grow as you get into your 70s and 80s.
Got it. Now, by front loading, does that mean I still have to contribute monthly to it, or is it just set and forget, or my monthly contribution is much smaller?
It depends on the size of the policy. We can structure anything you want. You could have it so there's no additional payments, or you could have it so that you can have it front loaded. And it could be like an $895,000 policy, right? So it all depends on what you want to do at the time. And your income may be strong. You may say, I need a $2 million policy, and you put in the front load, and then you have a payment every month as well. It all depends, or every quarter, or every year, however you want to structure it.
Wow, that's great. That's a really great way to do it. Now, so just kind of go, and I want to go back to whole life in a second. So you said basically there's two types of life insurance, right? There's term and there's whole. Can you explain a little bit of the difference? You had a great analogy, something like buying or renting versus buying.
Right. So term life is like renting an apartment. You pay a low fee on a yearly basis, and every year you get older, that amount rises, and as the cost of your mortality increases.
Right.
And so you can buy a 20-year term, okay, and and the contract will show exactly what you're going to pay every year, and that's fine. Versus whole life, which is like owning an asset. It's like buying a small house or an apartment where you have a fixed amount and you have a monthly payment or a quarterly payment or a yearly payment, and then you wind up with a cash value asset at the end. And there's also a hybrid in the middle called a yearly convertible term, where you can buy a term which has a 5-year time limit on it, and any one of those 5 years, so you're getting in. So this is a good policy for a young family where maybe money's a bit tight when the kids are born or the kid's born, and you do a yearly convertible term where you buy the term and you pay the money out, but then you convert to whole at the 5th year or the 4th year when your incomes are rising. Maybe your wife's got time for a second job, or your husband has time for a second job, or whoever the primary income earners are. And so then you're now funding the whole life policy, and you've got that as a savings vehicle as well.
Wow, that's great. So Jason, I want to move on because you have so much information here, and we always only have. I wish we had more time. Now, I just have one criticism, or let me just back up on whole life. So whole life, one of the general concepts is I'm putting in a fixed amount of money, and New York Life or any insurance company I do this with is promising me basically a guaranteed return at the end of the time period. Is that a correct assessment?
What they're promising a death benefit. So the question is, who is a beneficiary? Okay, so let's say the wife is the primary. Let's make it easy. Let's say the husband's the primary income earner. Okay.
Okay.
Who's the actual beneficiary?
Right. Most likely the spouse.
The spouse. Okay.
Right.
But it's in the actual wording, in the terms of the husband, it's not the wife, it's the widow.
Oh, got it. So
you have this, you have to think long and hard, right? So you have this death benefit that pays. Now, whole life also has some additional optionality. You can put in options on it that allow you to use some of that cash value for medical reasons. You can take cash out when you're, let's say you have a year left to live, you can take a large amount out and pay for medical costs and have a lower death benefit. So there's a lot of options you can add to the whole life policies. Okay.
Now, but with whole life, does it not become a cash surrender value at some point after 25 years, or do you?
Sure, it has cash value, and you can cash it if you need it. But if you don't, it continues to be a life insurance policy that pays out to the beneficiary.
Got it. Okay, that makes sense. So next on the topic you had was different kind of retirement accounts, and this is kind of geared for 1099, which is all real estate people, the gig economy, I was briefly talking, my first job is they had a 401k matching program that, obviously is long gone and that type of thing. So if you're, a gig economy or self-employed, how do you set up something for yourself? I guess from basic to more complex. You had a bunch of things here for us.
Right. So we offer retirement accounts. And the one that I would recommend for everybody is called a SEP IRA, a Simple Employee Pension IRA. And the reason why is because it's in your name or in your entity's name. Let's say you have an LLC or an S Corp and you're running your own little business. Or you can have it in your personal. It travels with you no matter what you do the rest of your life. And you are allowed to shield up to 25% of your gross earnings from the previous year, right? Or max out in 2020, you can max out at $57,000. So, so if you have a very good year as a real estate broker and you're earning about $280,000 and you don't have a lot of expenses, you could shield $57,000 of that earnings into a pre-tax account. And then you can have that invested in the stock market or the bond market or any myriad of indexes that you so choose. And we have 2,000 indexes and funds that are available for our clients at New York Life that want to open these types of accounts.
Wow, that's amazing. So that means, and you said that the number again was up to 57,000 or 20%, whichever.
25% or 57,000.
Or 25%, right? So that kind of goes back to like really living within your means. And I'll be honest, I started doing this just maybe like 3 years ago. Hindsight, I wish I would have done it sooner, but I did it. And it's amazing how fast that grows, that fund over time with not only by putting it in every year, but also with the stock market doing its thing. And, you can easily, over a period of 20 years, turn that into $1 million plus, right, Chris?
Easily. You just don't even look at it. You just put the money in the market every month or every quarter or every year, and you don't even look at it. It's probably better to do it monthly for the simple reason that you take advantage of the ups and downs of the year. But if you have one lump sum a year, the timing gets a little more tricky unless you just do it every year and you don't think about it.
Got it. Well, that's interesting to put it out. And that's the other thing is that there's really no, and just again, as someone who does this, and especially for 1099 or gig people, you may have clumps of money. So monthly may be too difficult, or end of the year may be too much pressure on you, right? So almost maybe after every big commission check or big check, you can put a certain amount in.
Absolutely. And there's no structure as to when you can deposit the money. It's open to however you want to do it.
Right. And then also what's nice is that, so let's say here we are again for the year 2020, in argument's sake, we're already halfway through the 7th month of the year. Do I have to put that entire amount in the next, 4.5 months, or can it extend into 2021?
I believe you're allowed to make the deposit up until the tax filing date.
That is correct.
For 2019. What's that?
I said that is correct. Not that it was a question for you, but my accountant always. Go ahead, Chris. That is the correct answer.
So they, because of the COVID era, the IRS moved the tax filing date to July 15th for 2019. So we just this week passed that deadline for making, your pre-tax deposits into your IRAs just on Wednesday, right?
Right.
Or actually, yesterday.
Which is great. I mean, and that's what Sean and I do with our, with our SEP IRAs is we put, when we have, paying ourselves first as each commission check comes in, and then come, January of that year before taxes are due, our accountant goes over all the numbers again, and if we're underfunded, we have those extra months to fund it up extra. So that's great, Chris. And again, I think that's just a great amount of money to put in. What else did you want to talk about a little bit with with
For
savings and
for
IRA?
people that are a little older, let's say people are 50 and older, there's a
Uh-huh.
product called a variable annuity, and it's like a personal pension, and you can have it being held in your IRA. So these things are designed that they can actually track the stock market as well. And the idea is that you have, let's say you build up your IRA to, a couple $100,000, and you have it invested in um, high dividend paying funds. Okay, so you're getting a monthly check from your account and you can
Okay.
have that money then fund an annuity inside your IRA, and so you don't really have to put additional money. Let's say you can put in, $500 or $1,000 goes into your annuity, right? And then you're 50 years old. Now, next thing you know, you're 70 and you've got this annuity that's worth, I don't know, $250,000 on top of what you have in the IRA. Okay. And now an annuity
Right.
is essentially like a pension where it pays you a fixed monthly amount. And depending how it's structured, you could do it till the end of your life. You could do it for 20 years. You could do it. And, it can have a death benefit. So that if you pass, it goes to your widow or your widower or whoever, it is, right?
Right. Wow, that's great, Chris. And then I have a question for you. So what advice do you have, let's say, and, also speaking here from life experience, right? When in my 20s, I wasn't thinking about retirement and all that stuff. So what about the people that are out there now? Sorry, my Siri just turned on for some reason. Anyhow, so what about people out there now, let's say like age 35 to 50, is a whole life insurance policy make sense for them? How do you, make up for lost time? Or you just say, I am where I am and move forward? Or what do you have for that crowd?
Well, in the 35 to 50, those are your strong income earning years. So
Right.
if you're living within your means and you've got you've actually bought a real estate, you're living in your house, or maybe you're doing very well and you've got a country house as well, and you can fund a whole life policy, that's what we recommend highly.
Okay.
So it's, again, it's another savings vehicle, and it depends on your income. It depends on, how strong the economy is, and the industry you're in, et cetera, like that. So, it's a lot of it's a personal optionality.
Okay. That makes sense. But I guess in some ways or what you're saying is it's not too late to start whole life.
Never too late. Never too late. In fact, we used to take insurance policies up to people that are 80, and then during the COVID era, they lowered it to 70. So somebody can actually buy a life insurance policy at age 69, because what's happened is the actual actuaries and underwriters, the numbers and the age of people living to is far higher than you can imagine. People are living into their 90s on a regular basis.
Right, right. And, with modern medicine, and if we take care of ourselves, I firmly believe I can live to be 120 and be healthy and happy and all that stuff. So it's a long-term thing, Chris, right?
Absolutely.
So how does, and then quickly, then I want to talk a little bit about your real estate story. Going back to kind of life insurance, how much does, like, let's say I'm starting a young family, or I have somebody and we're thinking of starting the family, or this whole COVID thing, like what's a baseline policy that would make sense?
I
Or
think
how do you calculate how much you need?
Well, okay, so there's two things. Under at $100,000 and under, there's essentially no medical requirements. So if you have any medical issues, you start with a $100,000 policy, and you can get you signed up right away. If you're in good health and you're a non-smoker, you want to try and get a 200, 250 size policy, and whether it's yearly convertible term or it's whole, it all depend on the payments you make. Now, there are life policies called variable life that allow that policy to be indexed to the stock market. So with interest rates as low as they are, more people are choosing to index their life insurance policies to the stock market because they have a higher probability of growing faster than with the interest rates where they are.
Got it. Okay. That makes sense. Anything else you want to talk about before we jump into real estate, or any points that you had that we didn't get a chance to cover?
No, I think we're okay there.
Okay. So yeah, so Chris, again, you like many of my clients have done very well with real estate over the years. Can you tell us a little bit about your story on how you started and what you bought and what drove you to buy right away and renovate and sell and all that jazz?
Sure. The first thing I'll start with is the history of interest rates. So, as the sovereign debt structures globally have increased, the interest rates continue to come down. As we've noticed in this last pandemic period, the Federal Reserve has lowered interest rates dramatically, and it's a situation where the 10-year bond in the U.S. is now 60 basis points. Okay, so for 10 years of risk, you're getting 0.6% of interest on that instrument. So that's allowed mortgage rates to drop dramatically. And one of the strengths of the Federal Reserve and their policy levers is to lower interest rates, which allows people to refinance their mortgages, gives them more money in their pocket, or allows people to go into the real estate market and then buy real estate with a lower cost structure. And so that's one of the big strengths right now in the economy. And that will help us pull out of this COVID hole. It's going to take a while. It's what they did back in 2009 and 10 and 11 during the financial crisis. Okay. So on to my experience. I'm American. I came to work in New York out of college in the early 80s. I worked in the commodity exchange in copper, silver, and gold. And then an opportunity came up for me to go to Sydney, Australia, which I did in 1986. And while I was there, I started to save money and I was working hard and I was getting a leg up in my career. And a friend of mine came to me and said, look, there's a warehouse down here in Darlinghurst, and we wanted to do a conversion. So we bought the building for $975,000. And it was 2,200 square feet of floor. Okay, wow. And we had 5 floors, so it was a little bit less than $200,000 per floor. You can imagine prices, right? So we did a full gut reno, and we converted each floor to a big open loft. And then I was able to then. It took a few years actually. There was kind of complications, but it happened. And then I was transferred to Tokyo. And so I was in Tokyo. I just rented it out and earned, a return on it when I was there. Now, Japan is not a place where foreigners buy real estate. So I continued to save my money. And then I returned to New York, and it was in April or May of 2000, or maybe June. And I'm walking around the village. I just arrived back that April. And I walked into Martin's office on Greenwich Street.
This wasn't planned, but I'll take the plug. Go ahead.
Well, no, but that's how we met. So I walked into your office and I said, I'm looking for a space to renovate that's got good upside value. And I gave you some parameters, and you said, "Oh, I've got just a place. Let's go look at this place on 119 Waverly." So we went over there, and the tenant had been there for 30 years, and it had been rent controlled, and they were able to they were bought out, and it was for sale. So we bought that space and did a full gut reno on that one, which was an 1880 townhouse. It was a second floor, the parlor floor. It was a beautiful location across from Babbo, and that took a couple years to get through that whole project. And then I had the joy of meeting my wife, and she was living in the Upper West Side. And she's like, I don't really want to live in the village. I want to live on the Upper West Side. So I'm like, okay. So.
And this place was completely renovated, by the way. I remember that. You were ready to move in, but love interceded with your plans in a good way.
I never slept in it one night.
But you made 100% profit inside of 2 years.
It was a pretty good return. It wasn't that high, but it was pretty good.
Right.
So then we moved to the Upper West Side, and we had a baby, and then we had another baby. And we realized we had to find a bigger apartment to live in. So we started looking for an apartment, and we found a nice apartment on Riverside Drive. And we wound up selling the Waverly apartment to help pay for the one in Riverside. And Riverside was a classic 7,
Wow.
overlooking the Hudson River with 8 windows on the water. It was a 5th floor, so it was above Riverside Park. You could see the water. And we did a full gut reno on that one. And that was, these renovations are always tricky, as you well know.
Right, right. And I think that's one of the common threads here, Chris, is that you bought properties that needed work and you were willing to do the work to get it in.
That's right.
And that's
all
how
of them.
a lot of sweat equity went into it. And then I know just from there you were there for a couple of years, hit the market right, and then you ended up in Bronxville, right?
And we moved to Bronxville, and we did it again. We sold the Upper West Side, and we bought a house in Bronxville and did a big renovation there too.
Wow. That's amazing. And that's great. So that's another, great way of building, putting in sweat equity. And you didn't do the renovation yourself. You hired people, obviously, to do it.
Yep.
But you still had to manage it. You still had to find you couldn't live in these places when they were being renovated, but you were willing to take that inconvenience to build a huge amount of equity long-term on it.
It was worth every time. It was worth it.
That's great, Chris. Well, if you can believe it, it's already 1:30.
Wow.
These things always go by super, super fast. So I just wanted to thank everybody. We had Chris McCormick here from New York Life. He has his info in the chat box in the reprint on this, Jared, right? We'll have all his information and everything when it goes on YouTube, and we have some clips on it. So again, Chris, thank you so much for your valuable time today. You got everybody thinking about what they need to do and how to, I think the big takeaway here is, create a habit, start early and stick with it and pay yourself first. Right, Chris?
Couldn't agree more. And I think New York real estate will be a very good opportunity in the next couple of years. So keep an eye on it and contact Mark.
I'll take that. Thank you, Chris. Thank you, everybody. And we'll see you next week.
All right.
Bye, guys.
You can hold on, Chris. You can
Bye.
hold on for a second, Chris. I was to get it off Facebook.